Let's pick up on that. Do you think they did it? Did they intervene?
What do I care whether they intervene or not? Over the years since 1990, they have spent 98 trillion yen in trying to manipulate the forex market. Generally, the effects are hours rather than days. So, if they want to sell dollars at 150, it isn't a bad deal. But clearly, if you want to affect the currency markets, you do it by changing interest rates. Now, look at the way that interest rates have gone. They moved in December. They took the yield curve ceiling from 25 to 50 bips. From up to 25 in July. They took it to 50. Since then, we've gone from 50 and this morning what we're trading at 80. The speed at which we're moving, you can see the BOJ is tapering what they're doing. The foreigners are starting to short the market. We'll be at 100 by Christmas, which is where 10-year swaps are at the moment. I think we'll be out of this ridiculous situation with yield curve control, possibly even this year, but certainly by the end of April.
So Nick, you're saying 1% for the 10-year JGB by Christmas. I mean, that's certainly out of consensus here right now. I'm just wondering, why do you think we can quickly get there so soon? And is that going to force the BOJ to pivot, essentially?
Yeah, I mean, obviously, if you want to hold the yen at 150, you will need to let rates go up. But really, look at the Tuncom that we saw on Monday. They go to the trouble of asking tens of thousands of companies what they think is going to go on with inflation, and their forecast for inflation over 1, over 3, over 5 years are all over 2%. So, yeah, they can do as they're doing at the moment and stick that in the round file and ignore it. But I think the sensible thing to do at the moment is just admit mission accomplished. Now let's allow the market to find its own level.
Nicholas, last time we saw, in December last year, what happened with the tweak and how it sent bank stocks, financials really through the roof. Are you likely to see the same thing? Should we gradually see this yield curve control perhaps being relaxed, that we'll see a further uptick for the banking sector as a whole? Or, as I guess yesterday Richard Kay said, he sees the opposite?
Okay. I have been strongly recommending banks all since late last year. I've done very nicely out of them. They're highly correlated with the 10-year yield, but they're also very sensitive to the 10-year yield. So essentially, each basis point on 10-year yield is a percent on bank stocks. It's not as if they're expensive. They're trading at a deep discount to book. As rates go up globally, they're taking value stocks with them, and banks are just part of this. The best performers in all of this are stocks that pay a decent dividend yield. So, of course, that couple of quadrillion yen worth of household assets, 54% of it's in cash. It's right to be in cash when money yields you slightly less than nothing, but obviously you can get, say, 2.5% on dividend yield on stocks. Banks, you'll get considerably more than that. It makes sense. Look, this situation with the bond market is not sustainable. I just want to rub your face in it. I'm paying 0.345% on my mortgage at the moment, although I could have gone to a net bank and got 0.219%. Inflation, core inflation, is at 4.3%. So, money costs slightly less than nothing. It needs to change.